So, Damian, this is one of my favorite times of year, not just for Thanksgiving and Christmas decorations and everything else, but because we get to have this conversation toward the end of the year, tailing off the in conversation with series with a little bit of a look back at the year, a little bit of a look forward. And I think those are conversations that people really like to hear. So I'm looking forward
It's been
to.
an interesting year.
It's been a really good year to have this kind of conversation. Let me start off with the big picture.
Mhm.
Has it been a good year? Tell us why it has.
Right. Well, from an investment point of view, it's been a great year. When you think at the start of the year, when we were having these conversations, there was a lot of concerns out there.
Yeah.
People were saying markets have already gone up. I don't know. Is it time to get out?
Yes, that's right.
And you would have missed out. You
Yeah.
know, it's been a very strong year for equities and bonds. And for US investors, they've done pretty well by being diversified.
I think we've had a couple of opportunities to note a lot of lessons this year, right? A lot of lessons sort of staying the course and going through the volatility. And as you talk about sort of valuations, it feels like it's been not just a productive year in terms of gains, but a productive year in terms of sort of investment lessons reinforced.
Right. And I mean, the lesson we're all taught that, 101 investment is the importance of diversification.
Yeah.
And sometimes when one market is doing well all the time, like US market, people think, well, who needs to be diversified? Well, as you said, the lesson came in spades this year because by being diversified, we were able to perform much better than we would have if we were only in US equities, for instance.
Yeah.
So emerging market equities did amazingly well. International equities did well. And part of that was accentuated by the US dollar, which got weaker,
Yeah.
you know?
Which is funny because a lot of people were expecting these opposite. I remember that call being, repeatedly, it's going to do this, it's going to, and
Well, they called it US exceptionalism, wasn't it?
that was the phrase. Yes.
That was the phrase that people were using. And that hasn't really quite played out this year. So it's interesting.
I know you don't think this way, but is there anything that you look back at the year and say, I sort of got that wrong, or I wish I'd done that differently? Is there anything that you look back and say, that was the sticking point for me this year?
From an investment point,
Yeah.
I think everything has pretty much gone better than expected, to be fair.
That's great.
In terms of expectations, I've been surprised. I think when we look back to the beginning of April, the so-called Liberation Day and the tariffs and the surprise that gave the market, and the market was complete shock. The market was down almost 20% within a matter of weeks. I was surprised at how rapidly the market climbed right back and has continued to climb.
Mm-hmm.
The speed with which that happens never ceases to amaze me. So it's a lesson relearned, probably.
Yeah, that's a good perspective. I mean, politics and political interventions have played a big role recently, not just this year, but recently. And of course, we've had, given that we cover U.S. and U.K. markets and investors and so forth, we tend to focus on those two countries and the politics there much more acutely, though obviously globally everything has some impact sometimes. But there's been a lot in the news in the last few weeks and coming up in the U.S. and the U.K.
Yeah.
We tend to think long term. We tend to think strategic. But is there anything in the recent noise or in the recent headlines or in the anticipation of what may be coming that you're beginning to think, should I have any kind of rethink around portfolios?
Yeah. Well, I mean, we would never make decisions based on politics, but you can't help but be distracted by the nature of the debate that's gone on this year. It's extraordinary, really. I mean, I have never witnessed anything in my lifetime. I don't know if you can relate to any previous era of U.S. politics where the debate was so
Sadly,
severe.
no. Sadly, no. We've definitely been breaking new ground, and I think a lot of it is where we used to have policy debates, and each party would sit down and say, okay, what might this difference be if this policy versus that policy gets enacted? And you try and think about what that means for companies and markets and employment or whatever it might be. Here, it feels almost like a religious debate rather than a policy debate, and it becomes quite difficult to really think that through. And half the time, what someone says and what they do are completely decoupled anyway. So it
Right.
becomes really difficult.
I think that's the key thing is the decoupling, isn't it? Because it's the economy is going on one trajectory, but the market is going on an even higher trajectory.
Yeah.
And I think sometimes people have concerns about the economy. They've what's called a K-shaped economy. So where wealthier are continuing to do even better and those less fortunate are doing worse.
Yeah.
And that looks like it's continuing to play out, which may have some sort of political resonance next year as we have the midterm elections in the US. So
Right.
we'll see how that plays out. That'll be a watch point.
Yeah.
But it's been amazing that what we were all sort of watching the news and the headlines, but actually the economy, and I think probably one of the biggest surprises, one of the things you won't see in a headline is profitability, not just in the US, but outside the US, has surprised everyone.
Yeah.
Right. So I think that is just been extraordinary, but you won't see it as a story. It's not a interesting story. It's people want to get involved in the politics of situations and how that all plays out.
And sadly, the fear stories get a lot more airplay than the positive ones. So there's a real disproportionality on sort of the reporting of that. So I think the answer you started with was no, that there isn't something that is like, I need to fundamentally rethink some aspect of the portfolio. I think that's what you were saying.
Yeah, absolutely. And I think it's something we've talked about before, that our North Star is corporate profitability.
Yeah.
And that is, that has continued to do well, regardless of the background noise, is what I would call. And I think it's a lesson for all of us, is just keep focusing, and US corporates and global corporates have done well. If you look at 100 years of history, yes, there are always these setbacks. And, no doubt we will have a setback in the markets. We will have a pullback, but that's a healthy thing.
That's the nature of investing.
Yeah, that's the healthy thing, because then that allows you markets to move on higher. You don't want to go in just straight up in a line, because the inevitable fall will be all the steeper.
Exactly.
So having a correction every so often is not a bad thing. And I think it's probably about 70-80% of the time we see a 10% correction in the market. We've had one already this year. We will probably have some next year.
I've been playing with language, and I've been testing out in some of my conversations with clients, not calling it corrections or even pullbacks, but just reset. It's like, as you say, it's a natural part of the process. It has to happen. And somehow that sort of feels more palatable.
Yes.
It's like you're resetting so you can keep going again, as opposed to...
Well, and to say to people it's a good thing, you might feel
exactly
a little difficult to hear
Yeah.
when they're seeing their wealth coming down. But actually, this is part of the long-term plan.
Yeah.
What you're seeing is variability in the short term. Over 6 months, 12 months, that's just what we call variability. Over 5-10 years, that's when you're seeing the returns on your portfolio.
On the topic of sort of political noise, I think from a portfolio view, I think that's quite clear. I'll just speak from a client-facing view, that I think there is a lot of conversation happening. From a year ago when we saw the UK budget come in and change things around pensions and capital gains tax. We've talked about that, obviously, since then. When there's the potential for changes, I think it's probably less on the portfolio side and probably more on the client-facing side.
Right.
That we end up having some conversations. What if there's a change to this? What if there's a change to that? Quite difficult to try and proactively think we know what's going to happen, and therefore think you know what to do in advance. That's quite a dangerous game to try and play.
It's very dangerous.
But you do have to at least have the conversation and try and help people think through the potential range of implications. That's what we're doing anyway, right? The scenario analysis, the cash flow modeling, all of that is about trying to help clients pre-experience to some degree a range of future outcomes, and then trying to help them make as best decision as they can based on their situation and those range of outcomes.
Yeah.
So I think we're probably having more activity on the sort of the client-facing side than on the portfolio side on this topic.
Absolutely. And because we haven't moved portfolios dramatically recently, and may not do so next year either, I think there's people can take heart from that, because it's not that we're not thinking about
That's important.
risks.
Right.
There's a reason I have this gray hair, is I'm looking at all of the risks. I'm concerned and thinking about them on a daily basis.
Yeah.
And there will be events next year. We're going to have a new federal governor in the US. What are the implications for markets? How will I digest that? It's only one person. There's still going to be more people around the table, so
Yeah.
their voice will be diluted, whoever that person might be. What's going to happen with tariffs? Are we going to see a bigger impact next year
Right.
than we saw this year? Those are kind of watch points, and there's going to be a lot of things. There's also going to be things that we haven't
Anticipated.
anticipated at all. Absolutely. So that's the nature of markets.
Yeah.
Clearly, we're at a point where valuation is going to be topical.
Yeah. But as you say, valuation isn't in isolation. It's in relation to profitability, right?
Right.
And
Exactly.
you can't decouple those two things.
Correct. And that's why we've seen markets in emerging markets, international and US, all move higher, is because we have seen that step change in profitability.
Right.
And that's supportive of valuations. Now, that's not to say there aren't areas that we are very cautious on, because there are areas of the market that we are cautious on. And I was cautious on it this year. And areas we've talked about before, like the Magnificent Seven,
Yes.
the AI related stories, which have become an extraordinary part of the US story. I mean, they're now 40% of the US market, which is,
Unfathomable.
it's incredible.
Yeah.
And, where people thought, I'm going to be passive and widely diversified, those passive people, they're now in a very narrow
Very
portfolio.
concentrated, yes.
And ironically, our portfolios are more diversified than something like the S&P,
Yeah.
which gives me heart, because I know we're going to own a lot of these companies that are benefiting from AI,
Right.
but we're cautious on the amount that we own. So if they do fall, our portfolios won't fall as much.
And I think that perspective is really important. So a lot of the conversations with clients center around how much return do you need to achieve your goals? How much risk is appropriate for your situation? And that the barometer isn't how much is NVIDIA up versus your portfolio. That's not the barometer. The barometer is you are achieving more than the returns needed to achieve your goals in a more risk-controlled, more diversified way. So that's more sustainable, more repeatable, more persistent over time.
Right.
As opposed to, well, that stock is up this amount. That's not the relevant comparison.
Exactly right. And being diversified, that's really helped, because we've been focused on some of the cheaper areas of the market, like emerging markets or international, and that's benefited our portfolios. That's why we've had such a great year. When we look at our peers, why we're doing better than them, that's the major reason. And it's partly is being diversified. So we're not saying which of the Magnificent Seven or which of the AI hyperscalers, as they call them, is going to be the winner. We're going on a bit of all of them.
So you touched on something I wanted to touch on in this sort of looking back at a pretty good year. How have we done relative to competitors? To what extent we know that? And what has been the culmination of that success in terms of assets and growth of wealth and so forth on behalf of clients? Would be a nice way to tie that together in terms of what a good year means.
Right. Well, I think part of it too is our approach. It's not about being smarter. It's about being disciplined.
Good.
So we would like to think we're more disciplined than our peers. And there's always a temptation amongst our peers to try and tweak their portfolio.
Sure.
Because they're saying, well, maybe these tariffs are going to have a negative impact. That's a plausible reason to adjust risk in your portfolio. We were cautious about taking an approach like that. We're very much long-term focused. So we didn't think it was going to reduce long-term returns. So we didn't adjust risk in our portfolios downward.
Yeah.
And those who did have paid a price because markets have continued to rise higher. So that's really helped our portfolios. Also our diversification, I think being probably more diversified than our peers has helped.
Fantastic. So Damian, in this conversation about, a really good year and frankly, a good run in general, help people understand, what does that culminate in? What does that sort of quantify what a good year looks like for the firm, for clients, et cetera?
Yeah, I mean, for clients, this has been a strong year because markets have been up so much. So that's been terrific. And I mean, we can see it in the overall size of our business.
Mm,
Because our clients' portfolios have been up so much,
right.
the size of our business, and it's hard to believe. I mean, you've been with the firm longer than I have,
10
but
years now.
10 years?
Yeah.
Congratulations. But at five, we're almost at 5 billion. We're,
Yeah.
very close to 5 billion in assets. I mean, you must, that must feel extraordinary to you.
Well, it's not just the size, it's everything that that means, right? So it's the growth and wealth for clients and what that means for their peace of mind and achieving goals. It's
Right.
the pace of that growth. I mean, I think it's almost $1 billion has been added in the last 12 months, something in that range between market growth and assets or something like that, which
Yeah.
is stunning to think of the pace of growth increasing that much and what that means for how many new households we're helping,
Yeah.
how much wealth they're creating to achieve their long-term goals. Just it yeah, we're not saving lives. It's not brain surgery, but it's really impacting real people in a really positive way. And it's fantastic.
And where is the sort of demand coming from? Because everything you read in the newspapers is about people leaving the UK. The non-doms are exiting, so everyone's getting out before the budget comes. Um, what's keeping our business? Because it just seems like the amount of demand for your time and for other wealth managers is been extraordinary this year.
It has been extraordinary, and it's funny because you talk to accountants and lawyers and everyone in the sort of the ecosystem, and everyone's been busy and everyone seems to be growing. So clearly, there's something systemic happening there, and part of it is while a lot of non-doms, especially over the last 12 months with the budget change last year, started to rethink if they wanted to stay in the UK with inheritance tax and so forth and so on. That was not so much the American expats because they were already globally taxed. They were already subject to global taxation. So,
Right.
their world changed a lot less than other non-doms.
Right.
And with some of the new tax regime in place in both countries, we've covered them in other conversations. The UK still looks incredibly attractive, perhaps even more so with some of the chaos and noise happening in the US on a policy basis, on an economic basis, et cetera. So, you talk to education consultants, you talk to real estate people, you talk to immigration people. They're sort of the front lines of this massive influx of queer inquiries and actual people coming across from the US to the UK. So clearly there's something systemic happening in a big way. But I think part of MASECO's success in particular is the investment that the firm has made in itself, in back office systems, in growing its own people. We don't tend to hire in lots of people. We tend to train people over the years. They've all, matured into an incredible group of well-trained, proactive, client-focused people. And that just means our reach is broader.
And
We're able to look after more people.
We're specialized too. And I think other people who have been in the same area looking after expats have diversified into other areas, but we've kept that focus.
Yeah.
That must
Very much like investing, right? So
Right.
keeping that discipline really pays off over time. And I think clients are feeling that themselves in, more detailed tax reporting and all sorts of little things that are just, hey, we can make this better. And with a larger firm with more resources can do those additional things to improve the client experience. And I think clients are increasingly feeling that and seeing that too. So yeah, I think that piece has been good for MASECO and clients and everybody.
and you don't see that changing.
I think I see that accelerating. So just like the pace of growth of assets is accelerating, I think that creates more resources to do not just one project, but 5 projects or what have you. So it feels that the pace of that is changing in a good way.
Yeah. And I mean, I know you guys have done great work on the financial planning side, but I think on the investment side, we've done our bit too.
Yes. Yes, sir.
And the markets, of course, have been
Yeah.
have helped as well.
It's
Been
been
a
a-
quite
it's been a
conducive environment.
Strong tailwind, exactly.
Yeah.
So Damien, in the context of a good year, let's go into the details. From an investment perspective, a good year usually means good performance.
Right.
So I know that that's been true, but help people understand what that means. We would give a frame of reference, give
Sure.
some dimension.
We're not at
around
year end
that.
yet. I don't want to tempt fate,
Good. Yes, good point.
But you're right. It has been. I mean, I'd be happy to to finish the year as things stand, it's been very satisfactory from an investment perspective.
Yeah.
And relative to peers, actually, we've done quite well. Why have we done well? I think it's the nature of our process, being diversified, being disciplined,
Yes.
not trying to tactically time markets, because it was a market environment that invited emotions.
Yes. A lot of volatility, a lot of,
and we stayed disciplined.
Yeah.
And our clients have been rewarded for that, and they've stayed disciplined. So that's been great for our process. It's just seeing it working as well as it has done. Being diversified as much as we are, that's something that's come to help our performance and enhance it this year.
and you've touched on some of the drivers of that performance, some of the elements around the asset allocation and so forth that have driven that. When you talk about peers, where do you see or sense that there is a difference in our diversification or our emphasis versus theirs that has resulted in some of that outperformance on a relative basis?
Sure. So the weight that we have in international and emerging would seem to be bigger than some of our competitors. That has helped. Our diversification, bizarrely. So we've had an market environment where 5 or 6 stocks contributed the majority of that gain.
Right. Yeah.
If you didn't own some of those companies, it really impacted your performance. Now we've owned all of them, which has helped our performance. And I think it's by being more diversified. Sometimes people think, well, if I'm diversified, I'm not going to make as much money.
Sort of missing out.
You're missing out
on the good stuff.
And it's actually been an interesting year in that respect, in that by trying to pick the winner, it was more difficult, and it probably will be next year as well. If you're trying to pick the 1 or 2 stocks, is it going to be this AI player or the nature of that industry is changing. The people in that industry don't know which is going to be the ultimate winner. So being diversified, I think, has really helped, and that's helped our performance this year. But if you look back over sort of even 3 and 5 years, we've got, when I sit down relative to and talk to some of my peers, I get the sense that we've had a very strong time. And I think part of it is by being a bit more of a long-term thinker, not getting wrapped up in the emotions of markets,
Right.
and staying the course. I think a lot of firms have tried to do that, and that has hurt their performance, albeit with the best of intentions.
Yeah.
Right?
Yeah. No, exactly. It seems like, well, this is obvious. We know that this is happening. We know that they're saying they're going to do this, and therefore we should, as a result of this very obvious announced intention, we should take this reaction. It's tempting to do that.
Right. Exactly.
Damian, obviously the year isn't quite over yet, but inevitably this time of year we start to think of not just what's happened, but what's coming in the future. And it's a little bit funny because December is a rather arbitrary time. We should always be looking forward anyway, but nonetheless, it's kind of a habit that certainly the industry has as we approach the end of the year on a calendar basis to start to think about what's coming up in the next year. We're not quite done with this year. I think by the time that this is actually released to clients out in the world, we probably will just have had the UK budget released. That's something that is, as of today, coming and will be, we don't know what that's going to be. It's an uncertainty as we sit
I think
here.
we have a webinar on that.
Yeah, we'll make sure that gets covered specifically so that topic will be covered extensively in that separate session that we'll share with clients at the time. But we have very near uncertainty like that coming up. We have next year U.S. election cycle. We know how noisy that gets, how crazy that can get. We have challenges to Fed membership, and we saw markets react when Trump was challenging the Fed chair and all sorts of things. So it seems like there are some known points of interest, I guess, coming up, as well as other sort of macroeconomic issues. Maybe help put some of those issues on the table in terms of, as you think forward, what are some of the big macroeconomic topics that we know are coming and we need to be thinking about?
Okay. In terms of big macro themes, one of the big themes is that governments are still putting more money into their economies.
Right.
right? So there's going to be what we call a fiscal boost.
Okay.
The outlook is also for monetary expansion. What does that mean? It means interest rate cuts. That's still on the cards.
Okay.
So that may help markets next year. At least in most countries, they still have ammunition in that sense. So if economies start to slow, they can start to reduce interest rates more rapidly than they have been doing.
Right.
Now, that's also contingent on inflation also becoming less of a force. And it's been still pretty persistent,
Yep.
but it doesn't look like it's going to rise like we saw a few years ago. So that's out of the way. I think one of the things as we go sort of from the macro, from looking at monetary and fiscal expansion, and we look at the markets, they are a bit expensive relative to history.
Okay.
Now, there is a good reason for that, which is corporate profitability is very strong. And there's going to be all this boost that we see next year from things like the government's putting more money in the economy,
Right.
interest rates, and also more money going into AI infrastructure
Clearly.
is going to happen
Yeah.
as well. So there's a lot of positives out there
Right.
that's helping support the marketplace.
Yeah.
I think that the challenge for us is to consider to what extent all of these stories, these expectations are already embedded in the market price.
Yes. Yes. So that's the key, right? It's you can't look at these things in isolation. It's what is the valuation relative to the fundamentals? What's already in the price?
Correct.
Yeah.
And nobody knows.
Right.
That's the challenge. We will be watching at different events, sort of like around the Fed, what's going to happen there. Politically, there will be some noise, I'm sure. But really, the focus is going to be on corporate profitability. And the expectations are still pretty good for corporates, both in the US and internationally. So
Let's pick up a bit. You were talking about money from governments. Some of that probably is some of the defense spending, sort of Trump fueled. Everyone's wrapping that up. So that's probably some of that government money in defense industry.
that's right. Yeah.
AI money is a big piece of that sort of money getting invested all around the world. When you look at those types of themes, is it positive? Is it dangerous, like overinflated? Is it tempting to try and lean into these themes that we think we know all this money is going to get spent?
Yeah, it's tempting to lean into those things, but I think the lessons learned are that be careful, because these things can turn around very quickly, and you don't know what's in the price. And that's why we tend to look much further out, like 5 or 10 years. Now, for instance, Europe is an interesting place because there's now more of a focus from European governments on spending on defense.
Right.
Now, of course, there's not a great narrative behind that. There's a concern about what's going to happen, whether there'll be an escalation in conflict that we've seen in the Ukraine and between Ukraine and Russia, and whether that could escalate further. As a precautionary measure, governments are spending more on defense and in line with their NATO agreements. So
Commitments. Yeah.
So that's going to be in actual money terms. That's going to actually involve quite a lot of money going in. Now, it's not a great reason for money coming in, but there will be a lot of companies that will benefit from this extra spending. Obviously, defense companies,
Right.
but infrastructure will also have to improve as well. So we're going to see quite a lot of that. Some of it next year, but it's more of a longer term theme than just sort of the next year or two. That's going to have a substantive impact on some markets.
It is interesting how these themes change over time. There was a theme in the early days of the Russia-Ukraine conflict around energy independence, energy resilience, investing in energy infrastructure. Now you have this going on. You have these rotating themes.
Right.
Even if we're not trying to chase them and say, ooh, let's leverage up on this defense company in Europe and think that that's how we're going to ride this theme in some very specific way. It must be a positive to broaden out the drivers of the market beyond AI, to have more things, to have that robustness of investment and growth happening, to sort of broaden the pillars of and drivers of growth.
Yeah, I think we have to be careful though. I think it's very tempting for people to get caught in themes
Yes,
and narrow themes.
yes.
People are talking about various subsectors within AI as being the next big thing. Um,
The hyperscalers, I
the
think they call them.
hyperscalers,
Yes,
the agentic
right.
AI
Yeah,
companies. So there are lots of areas of potential interest, and they are great stories.
yeah.
And I think that's one of the things that we have to be careful and stay disciplined about. You don't want to get caught up in a story because you don't know how quickly that can change. I mean, we saw in healthcare, a great theme in recent years was these weight loss
Right.
drugs.
Yeah.
And those stocks soared, but it was over a matter of months. And really, a lot of them have suffered, for the last year or so. So these themes can die really quickly. And I think that's why we want to be more broad based. We want to be diversified. We want to stick to what we know, which is the drivers of our performance, which are things like valuation, which is going to keep us safe and away from the more expensive, frothy areas, the great stories. But profitability is also going to give us some balance to the portfolio. So we want to be somewhat exposed to the improving growth we're seeing in economies, but we want to do it in a very measured and balanced way. It's making sure that we're not paying excessively for those profits.
That is such an excellent description. So one of the topics we have to talk about is an area that we don't directly focus on, but as investment people, we'd be expected to have something to say, which is gold. I mean, what in the heck has been going on with gold? I've been around a long time. I've seen it go up and down. I think the thesis has always been, how exciting is it really? It doesn't produce anything. There's no dividend. There's no growth. It's simply convincing someone else to pay you more for the same thing you already have. So it's really a measure of psychology. It's a measure of fear. It's not a long-term growth asset. It's a store of wealth sometimes in adverse conditions, but it's not in and of itself a way to grow your wealth really, because there's no growth aspect to it.
Right.
And yet the price of gold has done astronomical things this year. We probably should say something.
Yes, we should. We should say something about it. And thank you for that question. I mean, it is going to get me in trouble because there are people out there that love gold regardless. And that's fine. I understand that. But our approach is very much looking at every asset class in a framework. So, I mean, you could put a value on anything, but there's difference between sort of having a proper valuation framework, which is like equities and bonds.
Right.
And then you have modern art, which
Right.
is perceived value.
Yes.
So Bitcoin has perceived value.
Right.
You don't know when it's cheap. You don't know when it's expensive.
Right.
And the same applies to gold. You just don't know when. You were buying it on the basis that there are going to be more people, as you said, more fearful than there are now.
Right. Yeah. Yeah.
And I think that's a dangerous investment proposition. It's interesting. There is also a perception that gold is your hedge in case things go wrong.
Yeah. That's the sort of the ancient history of what that played.
And that history doesn't play out that way. There have been events, the global financial crisis, there's been COVID. Gold didn't do all that for your portfolio.
It's important to remember that.
It's important. And I classify it as the unreliable hedge.
I like that. That's a good term.
And I think you have to be careful. It is a speculative instrument. As you say, it doesn't produce any income. It's lovely to look at. My wife loves looking at it. And, central banks have been buying a bit more gold than they have in the past. But it's not an enduring thesis to say, I think something bad is really going to happen and that people are going to buy gold, because bad things have happened in the past and gold didn't go up that much.
And the inverse is also a problem. So when I used to have roles more like yours, I remember firing managers who were in our group of managers who were doing phenomenally well, but they were doing well at the wrong time, right? They were supposed to be playing a certain role in the portfolio. These guys were supposed to be doing well, and these guys were going to do well in a different environment. And they were doing really well in the wrong environment.
Mm-hmm.
I said, thanks for the performance, but you're fired because now I'm fearful that you're going to play the role I need you to play when the time comes.
Right.
And gold is doing a little bit of that now, right? The fact that it's this up this much in these conditions,
Right.
that's
Is it
not the
is it
role
still
that's
good
supposed to be
value?
playing. Yeah, so
Is it expensive?
it's wonderful if you have it and you've
Yeah.
made money. That's great, but it does again call into question. I love that unreliable.
Right.
Will it do what it's supposed to do when you need it to do that?
Right. I mean, maybe I could throw it back at you in that when we look at our clients, do you see a difference between, from an age profile, those that are interested in having a discussion about crypto assets versus those who don't want anything to do with it? And what do you say to people in?
Well, that's another topic to get us in trouble. So I have said for years that it's not investing, it's speculation. And that's perfectly fine, but you have to know that that's what you're doing and act accordingly in terms of size and risk and so forth. And, some time ago when we had the advent of governments getting more involved, we had regulators getting more involved, you can access them through real companies and publicly traded securities as opposed to sort of dark web wallets and so forth. So some of the risks have changed about the means of speculating on that. And so the conversation has moved on a little bit, saying, look, if you really think you have to take a punt on this because the underlying technology, the blockchain technology is going to have some future and you want to ride that in some way,
Right.
Great, but recognize what it is. It's in the same vein as, you've got a friend who's got a company, they're doing something interesting, fine. You have a reason to have a viewpoint, but recognize that it's different than what you said in the beginning and you say all the time. Fundamentals first, and that links to valuations to then know that this makes sense, that you're paying the right price for what you're getting. And that math isn't available. So
Right.
it's a different kind of allocation of money. It's not proper investing.
I agree. I totally agree. It's this perception of value. And I think it's an interesting one that there's a generation that is enthusiastic about
Yeah.
it. And I don't know what Bitcoin's going to be worth in 5 or 10 years from now.
Yeah.
But it is speculative and there's going to be a lot of volatility. And I think maybe you want to own it, but I think if you have investment goals and you need a certain type of return and you're thinking for your retirement, you want to have the majority in assets that are more reliable than you would get in the crypto arena.
Yeah. So for both of these topics, for when we're talking to clients, it's clearly not core. It might be a side conversation, but it's not part of the core investment conversation that links specifically to their goals. In this conversation about sort of looking forward and what's coming up and what we're thinking about, look, I know we've been talking about AI forever in one form or another about companies and stock prices and so forth. We've touched on it a number of times in our conversation,
Right.
but right now, how things have developed and the amount of money being deployed or expected to be deployed, it's starting to get mind-boggling. I mean, hard for people to actually grasp. Can we just spend a minute talking about, what you're seeing and hearing in terms of this area? Because it feels like it's not just continuing, but blowing up.
Right. I mean, I think both of us remember the internet. I mean, for younger viewers, they won't know things like microfiche when you had to go to the library to look things up. And we're probably in one of those pivots in history where this is going to be transformational.
Yeah.
But I think we can learn from history in that while these technologies are transformational, trying to make money and trying to invest through them is tricky. You have to be careful because the time it takes for the winners to kind of win out and for the technologies to work and generate some sort of return for the investors tends to take a lot longer than people are anticipating.
Right.
And And right now, what some of these companies are doing is they're changing their depreciation policies to get sort of really deep on this.
Yeah.
And that is inflating their earnings because they're saying this won't depreciate for 6 or 7 years, when we know new technologies tend to depreciate maybe over 3 years.
Right.
And that's typically the kind of policy that these tech companies have used. So this is a way of managing their income. This is a way of trying to allay investors' concerns that they're not monetizing AI soon enough. And that is a legitimate concern. We do own a lot of the AI companies that are benefiting from this recent trend, but we are cautious in the amount that we will have exposure to, because there is a point in time when the market will say, we don't want to spend any more on this infrastructure until we feel confident that this can be monetized. And that's not clear. That's similar to, when the internet started. It took a while for these investment models to arise. And so we're going to be cautious on that.
Okay.
I think we'll own some of those companies, or most of those companies, but we'll be quite cautious. We won't maybe have a market exposure, a market-like exposure.
Which is probably not a bad thing. And I'd love you to help dimension to some degree the size of the investment we're hearing about and talking about. But there are themes that feel uncomfortably similar to themes and actions in the past. To some degree, it feels like the dot-com bubble way back when, in the early days of the internet, when the pet store would rebrand itself pets.com and just go track huge amounts of money and take off. It feels a little bit like the early days of the financial crisis, when you interviewed everyone afterwards and they're like, yeah, we know this makes no sense, but they're doing it, so we have to do it, and we can't get left behind, so we have to keep doing it. And you get this excess building and momentum building. It feels a little bit like the arms race back in various times back where against the former Soviet Union and so forth, where everyone has to just throw money at these things and no one can afford to be left behind. You hear some of the CEOs saying, we're going to put X billions at this.
Yeah,
and it doesn't matter that a lot of it will get wasted and will be wrong. We have to be there and be there now in a big way. And so it feels massive, but chaotic.
It's right. I mean, the numbers they're talking about, 500, 600 billion next year and more the year after. It's extraordinary, the amount. It really is extraordinary. And I think that's going to be a theme to watch going forward. I think being diversified makes me sleep at night when it comes to these things, because you don't know who the winners are. When we look back on when the internet was being built and the companies that benefited from that, there was a very small group of companies, and we're in a kind of similar era at the moment, but it's not quite as frothy as it was during the tech bubble, when we saw, as you said, any company with a .com after its name, going up 10% every day for extended period of time. It could get that way, and we will maintain our caution, because markets are never good, are they, at adapting to new technology? Because you really don't know, does it get supplanted by something else?
And you overshoot, and you have 5 versions and only 2 work, and all of that. Yeah, it's that transition is a messy wealth creation and wealth destroying process.
Right. And this is not to sort of say we have any problem with AI. We do believe that it's going to be amazing. It is going to have a change on economies. The nature of jobs is going to change. There's no disputing that.
It's impacting us as a firm.
It's impacting us.
We're investigating how to continually integrate AI into what we do and so forth. So, yeah, I think every firm in every industry are going to be impacted, hopefully positively, by the efficiencies and the gains.
But we'll still need podcasts with real people.
We'll have virtual bots soon. Well, Damian, I think we could probably keep talking for hours. There's just a lot of interesting things happening in the world, and your perspective is always really valuable to hear. But for now, we can probably wrap up. Wish all of our clients well as they go into the end of the year and the holiday seasons and wherever they are, and look forward to reconvening with you early next year to see how we did close out the year and what's coming next. So thank you.
There's going
as
to be a
ever.
lot to talk about, I'm sure.
Always is. Great talking to you. Thanks, Damian.
Thanks a million. Cheers.